I've been investing for almost 2 decades, which means that I've covered hundreds, if not even maybe 1,000 stocks. And there's a lot of stocks that I follow today. And recently, what I did is I went through and I rated all of these stocks that I followed based on their valuation. So today I'm going to talk about the 5 cheapest stocks based on valuation that I find. Now, when you do this, it's important to note that the tool you use matters because every stock and the company that it represents goes through different points of the business growth cycle. And so depending on where they are, that affects which tool you should use. For instance, you can look at the total addressable market for a company if they're in the first 2 or 3 phases of the business growth cycle, but it makes no sense after that. Multiples you can use in many different phases, but it depends on which one based on where a company is. You can do a reverse discounted cash flow analysis in phases 2 through 5, and it's worth looking at yields, especially free cash flow and shareholder yields for companies in stage 4 or stage 5. So I'm going to go through the 5 companies that were the cheapest. I'm going to show you which one of these tools I used to do that, and I'm going to go through the list in alphabetical order. So let's start out with number 1, which is Cava. And if you're unfamiliar with Cava, the quick elevator pitch is this is like Chipotle Mexican Grill only for Mediterranean food. Now, Cava is somewhere between stage 3 and stage 4, and I went through all of these, and I think that the best demonstration of the value proposition comes from using a reverse discounted cash flow analysis as well as a little bit of total addressable market. Let me show you what I mean. So I'm going to go over to my reverse discounted cash flow calculator right here. And what I want to show you is I'm optimizing free cash flow margins. That's important. I'm optimizing free cash flow margins at 13%. That's higher than Cava's are today, but lower than Chipotle Mexican Grills in its best years. I'm giving them a 3% terminal growth rate. A 10% discount rate means this would be a market matching investment moving forward. And in order, when I released this to my community, Stock Investing Mentor, the stock was trading for about $82 per share. At that price, this factored in roughly 23% growth per year that Cava needs in revenue because we optimize those free cash flow margins in revenue. 23% growth per year for 10 years. Now, that is a high bar, especially when we look at the fact, using the data from fiscal.ai, that they are only expected to get 23% growth this current year, 2026, and then it's actually expected to be below that in the following years. So you might be saying, Brian, why in the world would you consider this to be a great deal? But here's the rub. Cava has come out and said that they expect that they can have 1,000 locations by the end of 2030. Currently, they have 439. If they hit that goal from 439 stores today to 1,000 by the end of 2030, that's 18% annualized growth in just the store count. Annualized growth in the store count. So if those restaurants are able to come online and match the performance of the existing locations, well then same store sales only need to grow by about 5% per year, something that is higher than what Cava is doing right now, although Cava is doing very well in a tough economic environment. It's done much better than 5% for its time as a publicly traded company, so I don't think that's as high as a bar to climb over. But really, if we look beyond 2030, it's worth pointing out that the total number of Cava store locations is down here in the blue. And look at Chipotle Mexican Grill, which has over 4,000 locations. And so if we look beyond 2030, I think that the growth story here is actually quite compelling. And even though I don't use technical analysis that much, it is worth pointing out that we are now in a stage 2 uptrend where Cava is above its both 250-day moving averages, and that 200-day moving average is about to go up as well. All right, let's move on to number 2 on the list, which is Mercado Libre. Now, there's a whole bunch of different arms to this beast. There's Mercado Pago, a fintech solution. There's Mercado Envios, a fulfillment and shipping solution. Mercado Credito, which is a lending solution. And of course, Mercado Libre itself, which is an e-commerce solution. Now, this company is solidly in stage 4, and so we're going to use a reverse discounted cash flow analysis. Now, this is a little bit tricky, and here's why. Because Mercado Libre has started lending, free cash flow where it is right now, not a great way of figuring out what kind of revenue growth the company needs. Free cash flows are much higher than they'll be normalized because the company is lending money and taking in customer deposits, setting money aside for potential losses that they aren't really having leave the company's fortress yet. So I have lowered the free cash flow margins to say that optimized, they be at about 14%. That takes into account a lot of maintenance for capital expenditures for the company's logistics and fulfillment network. If we give them those 14% free cash flow margins, that would give them about $4 billion right now in trailing free cash flow. That's lower than it actually is. So I'm being conservative here. Give them a 3% terminal growth rate and a regular discount rate. And if we hit those numbers, then Mercado Libre needs to grow its top line at 8% per year. And as you can see using these numbers from fiscal.ai, 8% per year, that looks pretty great because the company is expected to grow 32% this year, 24% the year after that, 18% the year after that. And guess what? Using some other tools from fiscal.ai, I can also see that this company routinely beats estimates. Let me tell you what you're seeing here because you're going to see this a couple times. For instance, this blue line at the bottom, that shows what were analysts estimating that Mercado Libre would do in revenue in 2024. If you look all the way on the left where it starts, they were estimating the company would do about $15 billion in revenue. If you look all the way to the right for that blue line, they ended the year with about $20 billion in revenue. The bottom line is that analysts continually had to revise their estimates up. The company continually exceeded analyst estimations. And so when it goes up and to the right as it goes along, that is a sign that the company does very well compared to those estimates. So I showed you that they're expected to get well above the 8% mark over the next 3 years. Those numbers might actually be lowballing it, and they might actually be even higher. Now, that being said, I am waiting right now to add to my Mercado Libre shares because the market doesn't like what's happening. We are now under the 200-day moving average, a falling 200-day moving average and 50-day moving average, primarily because investors are worried about encroachment from competition, particularly Sea Limited and Amazon, and they're worried about the company's lending. Both of these things deserve a careful eye, but I think Mercado Libre has the upper hand. And because I already own so much of it, when this starts to turn, I would be inclined to add even more. Now, coming in at number 3 is a stock that I actually don't own, but I'm looking at. And it is none other than Nvidia, the chip maker behind this AI explosion right now. Now, Nvidia is kind of halfway between stage 4 and stage 5 just because it's growing so much. And so what we can look at here is both the company's multiples and a reverse discounted cash flow analysis. First, let's look and see on a forward priced earnings basis, Nvidia is only trading at 26 times forward earnings. And that is with expected revenue growth coming in the 60 to 70% ballpark figure for this year. As you can see, 26 is pretty reasonable, and even if you compare it to the company's 10-year history, it's trading pretty well below that average of 35 times forward earnings. We could also look at free cash flow, trading for about 30 times forward free cash flow, and that's about 20% below the 36% times forward free cash flow that the company has traded for in the future. Now let's do a reverse discounted cash flow analysis to also show you why I think this could be a pretty good deal right now. Nvidia right now has free cash flow margins above 35%. But I want to be conservative and say, look, let's say that eventually the competition will eat away at some of those margins. And so let's give them an optimized free cash flow margin of 35%. If they hit that, they would have $76 billion in free cash flow today. They actually have more. So I'm being conservative and saying they have less. I'll be a little bit more conservative with the terminal growth rate because even though this is a super cycle of AI that we're in right now, traditionally this tends to be a cyclical industry, and we'll give them a normal discount rate. Now, if you do all of those things, then the growth rate needed right now, revenue growth rate over the next 10 years for Nvidia is about 22-23%. Now, as I said, they're expected to do 70% revenue growth this year, followed by 28% the following year. And then in the third year, they're down to that below our threshold. Remember, we said 22, 23%. By 2028, they're expected to be at about 18%. Now, that being said, if they were to hit these numbers, it's worth pointing out that in years 4 through 10, they just need 17% revenue growth. But again, as I showed you with Mercado Libre, if we look at what analysts expect and what the company actually delivers, it continually blows past those estimates. Now, again, I said this is a stock that I don't own, but I'm looking at because I am not as well versed in this industry. And it's worth pointing out that right now, on a technical basis, this is kind of at a decision-making time. The stock's price is right at the 200-day moving average, and so it'll be interesting to see what it does moving forward, but I'm really going to be focusing on my due diligence on the company to make a decision about whether or not to make this an investment. Coming in at our fourth stock is Sea Limited. Now, Sea Limited is the company behind a three-headed monster primarily in Southeast Asia. One, Shopee's e-commerce site. Two, Garena, a gaming unit with a hit game Free Fire. And the third is Sea Money, now renamed into Money, which is a fintech solution in Southeast Asia. They also have some operations in Brazil. Now, like Mercado Libre, they actually competing against each other. This is a stage 4 company, and we will look at a reverse discounted cash flow analysis. Now, here's the thing about Sea Limited. Technically speaking, it would make sense to give them higher free cash flow margins than Mercado Libre. Why? Because they have a higher margin business in gaming that Mercado Libre does not have. But I'm going to just assume that I'm not going to give Sea Limited the benefit of that because I want to be a little bit conservative. And so if I am, then we can optimize these for free cash flow margins at 14%, which would give the company $3.2 billion in trailing free cash flow. I will give them a slightly higher terminal growth rate, a normal discount rate. And here's the thing. If Sea Limited hits those 14% free cash flow margins, and I think that's the big thing that the market doesn't believe that they can do, then revenue only needs to grow 3% per year. I mean, my goodness, look at this. Revenue is expected to grow by 26, 22, 17% in the coming years. And not only that, but starting in 2025, analysts again were routinely underestimating what the company could do. So why has Sea Limited fallen so much? Well, there's a number of different variables. Number one is TikTok Shop. It is growing fast, and investors are worried that they're going to take away market share, or Sea Limited is going to forever have to be investing in its fulfillment network to beat TikTok Shop. Now, I actually believe that those investments are smart moves for the long term, but I do realize that they will bring margins down over the short term. Another concern is their lending arm, just like Mercado Libre's. And finally, with the situation going on in the Middle East, Southeast Asia is uniquely vulnerable to oil supplies being cut off, and any type of inflation in that area would put a cramp, be a problem for consumer spending in Southeast Asia. And so that is weighing on the stock as well. This is already a large position for me, so I'm waiting to add more because I love this valuation. I love the anti-fragility of the business, and I would just like all three things to be going in my favor with the momentum of the stock before I add. Now, I've been talking a lot about my portfolio during this, and I've been tracking that portfolio since December of 2014. You can see my portfolio in the green right here, which is almost six-bagged over that time, and it is way ahead of the S&P 500 down there in the red, and it's ahead of the NASDAQ Composite. I bring that up because if you'd like to follow my portfolio and learn how I do these things, I have a program that's just for you called Stock Investing Mentor. The way that Stock Investing Mentor works is that every Thursday at noon Eastern, we have 1 hour of live and recorded sessions where one investing nugget gets passed on to you. This week, we're going to be talking specifically about the way that I'm thinking about what's happening in the Middle East and in Iran and how it might be affecting my portfolio. And I'm going to go through and show with each stock how that works. Speaking of each stock, you get full real-time access to my real-life portfolio, which accounts for over 90% of my net worth. anytime I make a move in there, I let you know. Every 6 weeks, a full valuation 360, and during earnings season, updates on the stocks that are making big moves. And finally, 24/7 access to a private online investing community. Now, if this interests you, click the top link in the show notes below and you can get 10% off a year-long membership to Stock Investing Mentor. However, that deal will run out on Wednesday at 11:59 p.m. So let's go on to the last stock that's on my list, and that is Transmedics, a company that makes machines that keep heart, lungs, and livers, and hopefully soon kidneys, alive for longer when they go through the transplant process. They also have Transmedics, a transportation unit which can fly these organs as well. Now, this company is solidly in stage 3, and I think it's worth looking at a total addressable market to value this company. Now, here's the thing. Before September 2025, management had guidance that said that they would do 10,000 transplants, organ transplants, by the end of 2028. To put that in perspective, last year, the company did about 5,300 transplants. So we're talking about roughly doubling in 3 years. But in September of last year, they upped the guidance significantly, and they said, forget that old one, we're actually ahead of that pace. We believe we can do 20 to 30,000 transplants by the end of 2030. That's an almost 6x the number of transplants on the high end in 5 years. That is fast growth. And so what we can do is we can build out different scenarios and weight them. We can make a bear case, a base case, and a bull case. And in the bear case, we say they don't reach that goal by 2030. They just have 15,000 transplants. The base case can be the low end of guidance, and the bull case can be the high end of guidance. We can figure out how much revenue can they get per transplant. Now, right now, they get about $120,000 per transplant. But over time, I'm assuming those costs will come down for a number of reasons, not the least of which is that kidneys usually will have lower revenue. And so we can build those in, and it gives us our revenue figures. Management has also said that they believe that by the end of 2030, their operating margins will be 30% or higher. So we can put 30% for our base case and make it lower and higher on the other two, which gives us our operating profits. And finally, we can slap a multiple on it, say 12 times operating profits for the bear case, or as high as 35 times operating profits for the bull case. And that gives us 3 different market caps what this company could be worth. Now, today, this company is worth between $4 and $5 billion. So if the bear case comes, we don't want to own this stock, because if it goes from $4 billion down to $3 billion 5 years later, that's a losing investment. But the base case looks great because it almost triples the stock. And the bull case looks even better because it almost 8x's the stock. But let's weigh these based on the risk profile, because look, there are things that could get in the way of Transmedics hitting its numbers. There are competitors. There is reimbursements rates. There are the complexities of expanding internationally. Let's just say that they have a 1% chance of the bull case, a 24% chance of the bear case, and we give them 0.75% chance of the base case, since management has continually hit their targets, and this is the low end of the target that they gave us. Well, if they do that and we blend that and make it risk adjusted, we've got a company that goes from a $4.3 billion market cap today to a risk adjusted $11.3 billion by the end of 2030. Now, that's a 21% return per year. That is double the market's return per year. Now, right now, similar to Nvidia, Transmedics is at a point where investors are trying to figure out how they feel. The 200-day moving average is relatively flat. The stock just actually fell below that. And I think that the medical device industry right now is having a tough time on Wall Street as it is. I already own a lot of this stock, and I'm just perfectly comfortable sitting on it given my allocation to this small cap stock. So these are the 5 stocks that I consider to be the cheapest right now, even if I'm not running out to buy them. We've got Cava, Mercado Libre, Nvidia, C Limited, and Transmedics. What 5 stocks do you think should be included? Because I might not be covering it. Let me know in the comments section below. And if you want to see what I'm doing in my own portfolio, don't forget to hit that top link in the show notes below to subscribe to Stock Investing Mentor. Until next time, Brian